War in the Middle East, a coup in Iran, sanctions on Russia. Every time headlines scream crisis, five oil giants quietly record the most profitable quarters in their history. The pattern is so consistent, it is almost invisible. While governments scramble and consumers pay more. ExxonMobil, Shell, BP, Chevron, and Total Energies use a precise seven-step model to turn disaster into dividends. Their profits surge before tanks even move, and by the time the crisis passes, the price floor never returns. It is not a conspiracy. The evidence is buried in public records and century-old contracts. How have they pulled this off again and again for 100 years? To answer that, we need to break open their playbook, step by step. Every record profit starts with preparation. Before a single headline warns of war or sanctions, the five oil giants are already in place. They spend years locking down oil fields, pipelines, refineries, and political connections, quietly building control over the world's energy arteries. When a crisis erupts, they are ready. A war, an embargo, or a sudden supply cut sends shockwaves through the news. Markets react instantly, pushing up oil prices long before actual shortages hit. Futures traders, analysts, and speculators drive prices higher on fear alone. The companies watch as the numbers climb, knowing their costs have not changed, but their revenues will. In the next stage, quarterly earnings arrive. Profits soar. Dividends are paid out at record levels. Share buybacks reward investors. Executive bonuses multiply. Government officials respond by releasing strategic reserves or offering subsidies, but these moves do little to break the company's grip. The giants remain essential to national energy security, so their margins stay protected. Behind the scenes, teams of lobbyists get to work. They argue that new regulations or windfall taxes would threaten stability. They push for expanded drilling rights, weaker rules, and more favorable deals. During the crisis, lawmakers hesitate to challenge them. As the dust settles and headlines fade, prices do not return to where they started. The new baseline sticks. Consumers pay more and the cycle is set for the next crisis. This seven-step pattern, positioning, crisis, price spike, profit, government cover, lobbying, and a new normal, has repeated for over a century. It is not theory. It is the documented playbook that has shaped every major oil crisis since the dawn of the industry. In 1972, Exxon, descended from John D. Rockefeller's Standard Oil, was already expanding its grip on global reserves. Board records from that year detail plans to boost capacity in the Middle East, Africa, and the Americas, investing heavily in new drilling, storage, and refining infrastructure. This groundwork meant that by the time OPEC announced its embargo in October 1973, Exxon controlled more oil at every stage, from wellhead to refinery to gas pump, more than almost any competitor. As OPEC ministers cut shipments in protest of Western support for Israel, panic spread through financial markets. The price of crude oil shot up from $3 to nearly $12 per barrel in just a few months. Futures traders responded to headlines, not actual shortages. Tankers were still moving, but the perception of scarcity drove prices skyward. Exxon's filings from late 1973 and early 1974 reveal the impact. Revenues soared as the company sold oil bought at old prices into a market now 4 times higher. Margins on every barrel exploded. Internal documents from the period show executives tracking the price jump almost in real time. One 1973 board minute notes the company's advantageous reserve position and predicts sustained profitability if supply disruptions continue. While governments scrambled to manage rationing and inflation, Exxon's integrated structure, including reserves, pipelines, refineries, and retail, turned market chaos into a windfall. The company's quarterly profits more than doubled compared to the previous year. Dividends rose and share buybacks accelerated. The architecture built before the crisis delivered exactly as intended. When fear and speculation took hold, Exxon was ready to capture every dollar of the spike. setting a new baseline for profits that would not return to pre-crisis levels. In the years leading up to 1953, the Anglo-Iranian Oil Company, which would soon become BP, held a near-total grip on Iran's oil fields. Backed by the British government, the company controlled extraction, refining, and export, while Iran received only a fraction of the revenue. The word control matters here. When Prime Minister Mohammad Mossadegh nationalized the oil industry in 1951, he challenged not just a corporation, but the economic interests of Britain itself. Nationalized was an act that changed the stakes. The British response was swift and coordinated. Government officials and company executives lobbied Washington, warning of lost Western access to vital energy supplies. Declassified records from British and American archives reveal how intelligence agencies drew up plans for regime change, citing the need to restore order and protect oil flows. These documents reveal a deliberate strategy. In August 1953, a joint operation by the CIA and MI6 removed Mossadegh from power. Tanks rolled through Tehran. The Shah, friendly to Western interests, returned to the throne. Within months, a new oil consortium was formed. BP, formerly Anglo-Iranian, secured a major share alongside American and European partners. The consortium secured long-term access to Iranian oil. The new concession restored foreign control over Iranian oil, with contracts guaranteeing access and profits for decades. Profits were written into the new arrangements. This episode set a template. When national governments threatened oil company interests, corporate and state power could combine to reverse the outcome. The template would be used again. The Iran coup was not just a Cold War maneuver, it was a business solution executed at the highest levels. The playbook of leveraging diplomatic, intelligence, and military power to protect oil revenues would echo through future crises. BP's role in 1953 stands as one of the earliest and clearest examples of a company using state alliances to secure resources and shape the rules of the global energy market. Shell's business model thrives in regions where uncertainty is the norm. In Libya, years of quiet positioning paid off when the 2011 uprising erupted. As NATO planes circled and the Gaddafi regime collapsed, more than 1 million barrels per day of Libyan crude vanished almost overnight from global markets. Shell's extraction and trading teams pivoted quickly, rerouting supply and leveraging existing contracts to capture new margins. The world's headlines warned of a looming oil crunch, and Brent crude surged from $96 to over $125 per barrel within weeks. Physical shortages took time to ripple through, but futures markets reacted instantly. Traders bet on scarcity, driving up prices even before tankers were stranded or pipelines were sabotaged. Shell's integrated structure, spanning wells, terminals, and shipping, allowed the company to profit from every stage of the disruption. Internal 2011 financial reports show a marked profit uplift, with quarterly earnings buoyed by the premium on every barrel rerouted or resold. While governments scrambled to stabilize prices and reassure consumers, Shell's operations continued largely uninterrupted, passing higher costs down the chain. The Libyan supply gap was temporary, but the margin spike remained. By the end of 2011, Shell's annual profits had climbed sharply compared to the year before. The company's ability to operate through chaos and to monetize instability set a template for future crises. In conflict zones, Shell's advantage is not just in extracting oil, but in turning volatility itself into a source of revenue. Chevron's ability to keep pumping oil from sanctioned countries did not rely on luck or market timing. It came down to paperwork signed in Washington. In 2018, as U.S. sanctions tightened on Venezuela, Chevron secured a series of special Treasury waivers that allowed it to keep operating in the country while competitors withdrew. These waivers, renewed repeatedly through 2023, were not handed out at random. Lobbying disclosures show Chevron's government affairs team met with Treasury and State Department officials dozens of times, arguing their continued presence would support American energy security and prevent Chinese or Russian companies from taking over Venezuelan assets. Internal correspondence later obtained through Freedom of Information Act requests reveals how Chevron's legal and policy staff coordinated waiver applications with U.S. officials, even as official policy called for maximum pressure on the Maduro regime. The result was clear. Chevron exported Venezuelan oil to U.S. refineries, while state-owned PDVSA faced strict export bans. Every barrel moved under the waiver meant margin for Chevron, and a tighter global market for everyone else. Total Energies, meanwhile, benefits from a different kind of advantage. The company's ties to the French state run deep, dating back to its founding in the aftermath of World War I. Board seats have rotated between company executives and top civil servants. During the 2022 wave of sanctions on Russian energy, Total Energies maintained joint ventures in Russia months longer than its rivals. Parliamentary records and company filings show that former Total Energies executives advised the French government on gas policy as the crisis unfolded. Those revolving doors ensured that French energy strategy and company interests stayed closely aligned. In both cases, Chevron's waivers and Total Energies' state connections, policy channels provided cover and continuity, allowing profits to flow even as official rhetoric called for tough action. The mechanics of crisis profit are not just about markets, but about access, influence, and the right signature at the right moment. Oil prices don't just move when a barrel is loaded or a pipeline is bombed. The real action starts in the futures markets, where contracts are bought and sold on speculation about what might happen next. At the Chicago Mercantile Exchange, traders react to headlines in real time. If news breaks about a conflict or a threatened embargo, the price of oil futures can jump within minutes, long before any actual shortage reaches the supply chain. This volatility becomes a leading indicator, signaling higher costs to everyone downstream, from refineries to gas stations. But the contracts themselves contain another tool, the force majeure clause. This legal language lets companies pause or renegotiate deliveries if war, unrest, or government action disrupts operations. During Nigeria's pipeline attacks in 2016, Shell invoked force majeure to halt shipments and renegotiate terms, passing the risk and the cost along the chain. These clauses don't just protect profits, they create space for new price negotiations whenever instability hits. Governments sometimes intervene by tapping the Strategic Petroleum Reserve, releasing millions of barrels to calm markets. Yet the Strategic Petroleum Reserve has strict drawdown limits and can only soften price spikes temporarily. Once those barrels are gone, the underlying shortage narrative returns and futures prices rebound. The mechanics are clear. Perception drives the initial spike, legal clauses lock in contract flexibility, and reserve releases offer only short-lived relief. This system amplifies every crisis, turning market anxiety into higher prices long before physical shortages arrive. In February 2022, Russian tanks cross into Ukraine, and oil markets react in real time. Within days, Brent crude surges from $76 to $123 per barrel. The headlines warn of global shortages, but the physical flow of oil changes only gradually. What moves fastest is price and profit. Over the next 3 quarters, the 5 oil giants post earnings that break every previous record. ExxonMobil reports $17.9 billion in profit for just the second quarter of 2022, nearly triple the year before. Shell closes out the year with $40 billion, its highest in over a century. Chevron and BP each clear more than $28 billion, while Total Energies adds another $20 billion to the tally. Altogether, their combined profits for 2022 exceed $200 billion. The pattern is clear on every chart. As fear spreads, prices spike, and quarterly filings show the windfall almost immediately. Futures markets amplify every headline, driving up the cost of oil contracts before any real shortage hits the pumps. The companies sell barrels bought at yesterday's prices into today's inflated market, locking in margins that dwarf historical averages. Each quarterly earnings call becomes a celebration of strong market fundamentals and disciplined capital returns. Dividends and buybacks flow to shareholders while consumers face the highest energy bills in decades. The crisis profit model is not hidden. It is documented in every public filing and price chart. Congressional records and legislative filings reveal just how deeply the five oil giants are woven into the machinery of government response. When energy prices spike, lawmakers race to approve subsidy packages, direct cash, tax breaks, or fuel rebates intended to shield households from the worst of the crisis. In 2022 alone, the US and European governments authorized billions of dollars in relief, but these measures rarely challenge the company's pricing power. Instead, subsidies flow through to the same firms reporting record profits, reinforcing their position as indispensable energy suppliers. Behind closed doors, lobbying teams work nonstop. Annual disclosures show more than $200 million spent by ExxonMobil, Chevron, Shell, BP, and Total Energies to shape legislation and regulation. The filings are public, but the influence is often invisible. Meetings with key committee chairs, draft language passed hand-to-hand, and arguments that any new regulation or windfall tax would endanger jobs or national security. Former executives take up posts in energy ministries or regulatory agencies, blurring the line between company and state. The result is a shield of political cover. Subsidies that keep demand high and regulatory inertia that blocks reforms. Each crisis moment becomes an opportunity for these companies to reinforce their grip, not just on supply, but on the very rules that govern the market. The institutional resilience of the oil giants is no accident. It is built, year after year, through subsidies and relentless lobbying, documented in every legislative session and budget bill. Hurricanes have become another lever for record profits. When Hurricane Harvey struck the Gulf Coast in August 2017, nearly a quarter of United States refining capacity went offline in days. Companies like ExxonMobil and Shell declared force majeure on supply contracts, citing storm damage and safety concerns. Gasoline and diesel prices surged, not just in Texas but nationwide. The spread between crude oil and refined products, the refining margin, jumped to its highest point in years, as reported in quarterly filings. ExxonMobil's statements to investors emphasized the need for resilient energy infrastructure and framed the outages as proof of the nation's dependence on major producers. But while capital expenditures on stormproofing remained flat, payouts to shareholders climbed sharply. Public appeals for energy security dominated company press releases, while internal reports showed windfall profits from the margin spike. The playbook treats every climate disaster as an opportunity. Supply disruptions justify higher prices, and the narrative pivots from crisis response to long-term expansion. Each hurricane, flood, or wildfire is presented as a reason to double down on fossil fuel investment, even as the disasters themselves grow more frequent. The margin playbook turns environmental chaos into another profit engine, reinforcing the cycle that keeps both prices and emissions rising. Today, the combined profits of five oil giants in 2022 alone could have funded the world's largest renewable energy transition. Yet the cycle of crisis and profit continues, unchecked. As energy bills soar and the climate crisis escalates, the true cost lands on households and the planet. Until the pattern breaks, every crisis remains an opportunity, just not for those paying the price. What do you think should change?